This is Carolina Business Review. Major support provided by High Point University, the premier life skills university focused on preparing students for the world as it is going to be. Blue Cross Blue Shield of South Carolina, an independent licensee of the Blue Cross and Blue Shield Association. Sunoco, a global manufacturer of consumer and industrial packaging products and services with more than 300 operations in 35 countries.
Okay, holidays are over. Elections have been way over. We have to face the music now and in with the new, so to speak. So what are we going to do this year? Welcome to the most widely watched and longest running dialogue on Carolina business, policy, and public affairs, seen every week across North and South Carolina, and we try to analyze those issues that affect us most in this region. But now what? We've got a whole year ahead of us, and we've got an economy that seems to be still expanding. We've got a new administration in Washington. How will this year unfold? We're here to talk about it. This is part two of our two-part year-end, year-beginning specials, and we will look ahead in 2025 with our expert economists and economic insiders. Stay with us.
Major funding also by Foundation for the Carolinas, a catalyst for philanthropy and driver of civic engagement, helping individuals, nonprofits, and companies bring their charitable visions to life. Truliant Federal Credit Union, proudly serving the Carolinas since 1952 by focusing on what truly matters, our members' financial success. Welcome to Brighter Banking. And Martin Marietta, a leading provider of natural resource-based building materials, providing the foundation on which our communities improve and grow. This is the Carolina Business Review Economic Forecast for 2025, featuring Sarah House of Wells Fargo, Mark Vitner of Piedmont Crescent Capital, Dr. John Connaughton of UNC Charlotte, and Anders Persson from Nuveen.
Happy New Year. Welcome to our program. Happy New Year. Good to have you all here. Sarah, you get the first pitch.
Oh, boy.
Yeah, isn't that always fun? So, Sarah, we've heard so much during the election, at the end of the year, et cetera, et cetera. Now we have a new president. We have a new administration. He's been very clear about what he and his team want to accomplish. If you strip away all the politics, if that's possible, and look at the clinical effectiveness of what the Trump proposals are, how do you think that affects 2025?
Yeah, so I think there's going to be a lot of potential policy changes that we've seen relative to the past couple of years. And I think, probably first and foremost, the one we're thinking about is what happens with tariffs. So this is something that can be done very early on in the administration, where I think there's going to be a lot of conversation about taxes in 2025, but that's not really something that's going to affect economic activity until 2026. Immigration is another one that we could start to feel some of that in 2025. But I think looking at things like tariffs, potential immigration curbs, a lot of those point to higher, at least stickier inflation in 2025 as you get prices initially going up. Sure, if it's a one-time level shift, you get inflation eventually coming down, but ultimately I think you're in for, policies that generally more inflationary and when we get to 2026, also, potentially bigger deficits as well if you were to take at least some of his policies at face value. Now, there's, I think, a lot of to unpack in there.
A lot of daylight between
face value,
sure.
But I think just that's the direction we're thinking about things.
John, what do you think that Trump's policies do to the economic momentum?
Well, they're certainly going to add uncertainty because we don't know how many of them are policies he's going to follow through on and how many are negotiating positions. Like, for example, Sarah was talking about the tariffs. But I think in terms of tariffs, if you think about this, first of all, I got to set some things straight here. Tariffs are not sales taxes. So if you go into Target and you look at a $50 toaster, and all of a sudden there's a 10% across the board tariff on all Chinese imported products, the toaster is not going to be $55 because the tariff is imposed on what's called the last sale price, which actually occurred in China when the factory sold it to the exporter. Okay, it shows up on the American shores, and that's where the tax is imposed on that sale price, which could be $15, $20. So a tax on what looks like a retail $50 toaster may only be $1.50, $2. And that gets split between buyer and seller. So at the end of the day, the impact may be $1, which is a 2% increase in the price. So that may be all that happens with a 10% tariff. I digress a little bit. But we don't know what's going to, we'll probably see tariffs on Chinese products. I don't think that's I think that's going to happen. That'll be a little inflationary. We're also going to see some tax cuts, more so than just a continuation of the 217 tax cuts. That's going to be inflationary. And also, if we start deporting lots and lots of immigrants or illegal aliens, however you want to call them, undocumented folks, if we deport too many, that will put constraints on the supply side. That could be inflationary as well.
Mark?
Well, yeah, I think it's important to judge Trump or view Trump against the earlier Trump, 2.0 versus 1.0.
You think it's dramatically different?
I think it's dramatically different. I think there's some things that are the same. Peter Thiel is famous for saying you need to take Trump seriously, but don't take him literally. And so yeah, he's going to raise tariffs. I mean, that's absolutely going to happen. There are going to be some sort of deportations, but they're going to be starting with criminals, which I'm kind of like, well, if someone's committed a crime here, I don't want to deport them and then have them come back and do another crime. I mean, you would think that they would be put in jail and then be deported when they get released. But in any event, I don't think that's going to be as immediate. I think that they're probably going to find ways to be less disruptive. The other thing is that folks need to look at this more globally. I mean, the world's changing. We're operating in Trump time where everything's happening very fast. Yeah. And with Assad falling in Syria, I think we're going to see a push between the U.S. and Saudi Arabia to drive oil prices down below $50 a barrel. And that is going to be a big disinflationary shock, and I think that happens early in the year.
Okay, I want to come back to the energy thing because that's a bigger issue that we can expand on. Anders, when you look at fixed income, when you look at exchange, foreign exchange rates, when you look at things all related to not just bonds and rates, what do you see when it comes to the Trump effect going forward?
Yeah, no, I certainly we're having to kind of price in, base case scenarios here. As Sarah and others kind of mentioned, it's a little unclear what the proposal and kind of discussions are about versus what's actually going to be implemented. I think another thing that we're trying to assess as well is the timing here, because that's going to have an impact as well. There's going to be some inflationary aspects here that we have to kind of price in. That's why you've been seeing Treasury rates moving higher effectively post-election.
What does that tell you then?
So basically, there is a concern that inflation will be higher for longer or stickier, and therefore rates going to have to basically be higher to reflect that. There is a concern that therefore, or at least a realization that the Fed probably is not going to be able to cut rates as quickly. So that's being priced in the market, both at the 10-year and the front end. So all of that is basically playing through in terms of the rate side. On the credit side, on the other hand, and the equity markets as well, there is a little bit that animal spirit kind of type aspect of it, where there's some comfort that the Republican administration is probably going to be quite friendly to the economy, to corporates, regulation, M&A, and what have you, and we're seeing that playing through as well. So two moving pieces there, effectively.
Okay, so sorry to interrupt you. So would you say that rates, and let's go around the table and get the forecast on rates for this year, you think rates are going to stay level?
Yeah, our anticipation is that the rates are going to be sort of a range around 4.5% on the 10-year for 2025.
But I'm talking about the federal funds rate.
Oh, Fed, sorry, yeah. So we're expecting the Fed to cut most likely 2 times in the first half of next year to really still make sure that they're, are thinking through what is happening on the inflation side, but also thinking about the dual mandate. So job markets, making sure that the unemployment rate is still under check, so to say. So we're expecting 2 cuts in the first half down to roughly 4% by mid-year, and then second half of the year is still much more uncertain at this point.
Rate cuts?
Yeah, so we're still looking for the Fed to continue cutting a little bit this year. So we have the Fed funds rate probably somewhere around 3.75%
Wow.
at the end of next year. But I think part of that, we talk about the inflationary impacts of tariffs, but there's also what we think will be a growth depressing effect too, where maybe not all of it's passed on to consumers, some of it's going to get absorbed by business margins, but that's going to make them less likely to hire and invest if their margins are getting squeezed. And so the Fed's going to need to balance that sticky inflation with, we think, some further deceleration in growth.
Mark, what do you think?
I've got 2 more cuts in 2025 and possibly 3, but I think it's important for people to remember the Fed's not putting their foot on the gas; they're taking their foot off the brake. So monetary policy is still restrictive right now. So it's going to become less restrictive, and so I think there's certainly room for them to cut at least 2 more times. Long-term rates are probably going to go up in that environment, and oddly enough, I think that mortgage rates are going to come down because the spread between mortgage rates and the 10-year Treasury is at least a percentage point wider than it has been on average.
Well, I think panel's right. I think that the Fed will likely cut probably 2 more rates early in this year, first half of the year. But I want to highlight something that Andrew said about this. I look at this thing and I say, there's the stock market and they're crazy people, and then there's the bond market, which are the adults in the room. Okay, and no, seriously.
Yeah.
And people need to understand the difference. So when you look at the previous last year where the rate cuts the Fed did, what happened in the bond market? When they cut the rate, they cut the federal funds rate, which is a rate they can set, and it's just the overnight rate borrowing between banks, okay? So it just has an effect on liquidity. What happened?
Meaning last year in 2024?
Yeah, what happened? Rates went up, right?
Yeah.
Yeah, so, the market rates went up when the Fed cut because the bond traders are not believing that Fed has control of inflation. Okay, and I suspect that may happen in the first half of this year as well.
I want to add just one thing, though. The other reason the bond yields went up is they're expecting more growth as well. So it's not just higher. It's not just that inflation expectations were bumped up a little bit. They're also expecting stronger growth.
I think when you look at the 10-year, it's inflationary expectations.
Let's shift to housing. What happens in housing this year?
So we think that we're going to still see some moderation. So given that rates are still high, I think in many ways still prohibitively high for a lot of potential buyers. So even as mortgage rates have come down, we think they'll come down a little bit further this year, but still probably stay above 6%. And so for a lot of homeowners, that just still doesn't make sense to move. That's going to keep supply in the existing homes market tight. And with that, not a lot of supply, still probably see some increase in prices and just keep that affordability challenge very much in focus. Now, in terms of the builders, so they've been able to buy down rates to some extent, but that's getting harder and harder the longer rates stay elevated. So we're expecting construction to slow a little bit further this year too, as builders are having those affordability challenges too in terms of making the math work for buyers.
Sarah, there was somebody had told me an anecdotal piece that builders were actually making lower loans to move their inventory out and basically eating the difference between what their capital cost them and where they were lending it out because they were making it up on the price of the home to sell the home. Is that over with, or are builders still doing that?
It's getting harder. So you're still seeing some of that dynamic, but it's getting harder. Again, the longer you're in this higher rate environment, there's less and less you can take a bite out of.
It's a finite number. Do you look at the housing industry when you price things out?
Yeah, certainly do. I mean, that is a very key component of the broader U.S. economy and the fixed income markets more broadly, particularly on the securitized. There's a lot of instruments that we look at that are housing related. So that's certainly on the mortgage-backed securities in particular, obviously very tied to that. So an area that we're spending a lot of time and being very focused on. I would concur with Sarah's view that it's probably a bit more of the same going into this year, so to say, not a dramatic shift for now, particularly if we have this a bit higher for longer backdrop where rates are probably going to stay fairly high. So not a major shift from what we saw in 2024, at least not for the first half of this year.
So housing nationally and housing in the Carolinas is different. I mean, it seems like, Mark, John, there's a lot of room to run yet in housing in not just the urban cores and the high growth areas in the Carolinas because of the in-migration, but it seems like, to use the analogy, there's a lot of red left on this candy and it hasn't been licked off yet when it comes to housing and exploding housing prices. Does that slow down?
I think that this year is going to be a pretty good year for housing in the Carolinas, and mainly because
Meaning prices going higher.
Prices are going higher. We got stronger population growth. We're going to get a little bit of a break on rates. Florida is having problems right now, and inventories are backing up on Florida. And one of the things that's going to make it tougher for builders to get aggressive on buying down rates is they've got some earnings pressures coming out of Florida because so many folks are shying away from Florida because of insurance issues, and they've had a buildup in inventories. And every time that Florida has boomed, we've seen an echo boom here in the Carolinas where people move to Florida and they say, gosh, it's crowded, it's expensive, it's a lot more humid than I thought. And they said, you know what, the juice just isn't worth the squeeze. I'm moving to the Carolinas. And so I think we're seeing that wave right now. And that with the exception of Asheville, which I think has got some longer running problems, it'll take them a little bit longer to get back up and running. I think that the Carolinas are going to have a pretty good year. South Carolina actually has stronger immigration than North Carolina does, even though the state's smaller than North Carolina.
I think South Carolina likes to be smaller than North Carolina because they can end run on a lot of things. John, what do you think about housing?
Well, I pretty much agree with what's been said. I think there's, nationally probably it's going to be down again this year. Locally, Carolinas could be up a little bit. But I want to go back to something was mentioned about Asheville and what's going on there. And I think it's gotten lost. So when we looked at the October 24 numbers for job growth in North Carolina, okay, we actually lost jobs. So the job from September to October dropped by 5,500 jobs.
Because of the natural disasters.
Because of the natural disaster. Normally we would add 6,000 or 7,000 jobs every month on average, okay? So when you see we didn't get the 6 or 7, and now we lost 5.5. We're talking about 13,000 fewer jobs in October compared to what it would have been had the hurricane not occurred. And two things that bother me about what's going on right now in Asheville, aside from the fact the feds are asleep at the wheel, unlike when you have hurricanes in Florida or on the Gulf Coast, and 70%, 80% of the people have flood insurance, nobody's got flood insurance. And most of the damage in Asheville area, in the mountains in general, was caused by rising water. And so you've got a lot of uninsured, and that's going to, as Mark said, it's going to delay construction considerably. Normally, we'd see a boom in construction in 25 to repair things, but it's going to take longer because it's going to require
let me zoom out from that, Sarah. So John brings up a good point. I wanted to ask this question about housing affordability includes the insurance around housing. If we've had not just Hurricane Helene, but we've had 2 or 3 storms that have rolled through the Carolinas this last season, does that increase in premium, is it a meaningful amount to a homeowner to factor into a housing cost going forward now?
I think a lot of it is. I mean, it depends on where you sit on the income spectrum, how long you've had your mortgage in terms of, where did you get it 10, 15 years ago, and or maybe it's even paid off. But I think for a lot of homeowners, the insurance portion has been certainly some sticker shock, and I think it's been delayed versus what we've seen in things like motor vehicle insurance. But you just think about everything we've seen in terms of the increase in material costs, labor costs. It's getting more and more expensive to repair. It's getting more and more expensive to replace. And so those insurance premiums, they've started to go up, and I think we haven't necessarily seen the end of that yet. And that is an additional squeeze, particularly for those newer buyers who are already buying at a very difficult price point.
Anders, let's switch gears just a little bit and talk about immigration and employment. Does with the Trump administration, will that have a meaningful impact on employment? And I know you want to answer that question.
Well, yeah, devil in the detail for sure, but if some of the proposals that we're hearing so far is actually implemented, yes, it will have an impact for sure.
A chilling effect, would you say?
Yeah, generally that is the takeaway, and as John mentioned, it can have an inflationary aspect of it as well. I think, one thing I've observed a little bit is that there's been a lot of focus on the inflation side of a lot of these proposals, but ultimately, I think Sarah mentioned this as well, there could be a slowing of the economy as well. That probably will come a bit later, but on the immigration side, I think that's something that we have to be maybe more mindful around. What is the sort of medium-term impact on growth going forward? Not just the inflation side, but short answer is yes, it will have an impact.
John, I'm going to not ask you a question, but I'm going to quote you because on this program, and I know in several forums, John has always argued, not to speak for you, I'm not your attorney, but he's always argued that the natural demographics of the country itself are going to make it difficult for hiring going forward because the baby boomers are rolling out, and it's a big hole that's got to be filled. Did immigration, was that the hope for employment, and is it changed now because of immigration policy?
It certainly was the hope, particularly in construction and agriculture, two very important industries in the Carolinas. And I don't think we're going to see mass deportations that affect workers in those industries. If you are here and you're here illegally or undocumented, or whatever the actual term is, and you're working, I think that what's going to happen is there'll be something called an administrative deportation, where you'll get a court date. Your employer will pay a fine, which will be served as a bond, and then you'll have to show up so that we know that you're in the country and that you're not a troublemaker. That trouble in Trump terms.
Yeah.
And I think that that'll be it. And there'll be and ultimately once Trump can claim that the border is secure, and that we push back on the gangs and people feel safer about what's in the folks that are in the country, then we can talk about putting people on a path to citizenship. And I think that's what's ultimately going to happen. I think one of the issues with immigration is that we've made it way too easy for people with no skills at all to come into the country, and it's very difficult to get people with skills to come to the country. And so we've got a little bit of a skills mismatch there.
In less than 2 minutes, I need you to wrap that one up because I want to move on to something before we're ending, and that's about the immigration and the employment.
Yeah, well, I mean, we've all, I think everybody at the table agrees that if the push goes too far, it could be problematic because Mark mentioned agriculture, construction, but also hospitality and leisure rely on these workers and have been relying on these workers for decades. So all of a sudden you get a real pinch in terms of availability of labor if it gets a little bit out of hand. And I'm a little bit less optimistic than Mark is about this. I think everybody agrees we got to get the bad guys out of town. But sometimes you do your job to generate numbers, and sometimes it's easier to pick a lot of people out of a processing plant, and you can get a whole bunch of folks. So I don't know what's going to happen. I know Holman has suggested that he's going after the bad guys, but he always says first.
Yeah. Okay. Thank you. We have a few minutes left, and Sarah, if you can't answer this question, I understand because it's not really the most pillar of economics, but Bill Belichick is now going to be the head coach and there's a question in here, I promise I'm not being flippant, at Carolina. But what that brings up is wow, we've got an NFL coach going going to college. We had Saban do the same thing with some pretty wild success. But the point is, there's a thing called NIL, name, image, likeness, and that refers to student athletes being paid now. We had Peter Hans from the UNC system on this program, and they are probably very concerned, is my term. How does NIL change the dynamics of higher education? It's going to be a big change, isn't it?
You just asked a football and economics question.
Yeah, I know.
And you have Mark Vitner sitting on your left. I'm going to have to pass this over to Mark. This is his sweet spot.
Yeah, I have been writing about college football the last couple of years, but you ended that with asking about education, and I don't know. I think that the name, image, and likeness may be disconnecting college sports from education, and that
is that bad or good?
I'm not sure. There's good and bad to it. A lot of college athletes are going to make more money playing college sports than they're likely to make doing whatever they do after they graduate from college. I mean, certainly, it's not just the football players. It's also gymnasts. It's basketball players that really don't have a path to the NBA because very few make it from college to the NBA. Yeah. And so I see some good coming from that, but I don't know that it has as much of a direct impact on education. Certainly universities want to get their name out there and they want to get their alumni engaged, and sports certainly help do that, and there's a lot of pressure to win, and the NIL deals are increasing that pressure to win, and I think it's really tough. getting Belichick to come down to North Carolina for a very large sum of money for a 72-year-old coach is pretty it's pretty impressive.
Well, and Anders, if you have an opinion on this, please. I don't know that most fixed income guys either want to talk about it publicly, but John, the idea that this is a big change, is it a sea change in higher ed calculus?
First of all, I think we're in a transition period here, so I don't think we should place.
And you have 45 seconds.
I don't think we could place too much emphasis on the fact that we're in transition, and things are going to change considerably as it relates to NIL over the next several years. You went from an exploitive environment to a free-for-all. Okay, when that exploitation rules went away because they were deemed to be unconstitutional, so now you're in a free-for-all. We're probably going to see collective bargaining down the road, and we're probably going to see salary caps, et cetera, or spending caps.
Does it take the innocence away from the student athlete?
A little, yeah.
Yeah.
But I think that's more the transfer portal than it is the NIL money.
Yeah, thank you. That's the last word. You all have been great sports, always. Thank you for being here. John, Mark, of course. Thanks. Sarah, thanks for being sport and doing it. And Anders, thanks for jumping in here. Please come back. We hope you will.
Thank you so much.
Thank you. Thank you for watching our program. Of course, we are very grateful for you supporting this program. Happy New Year. Until next week, good night.
Gratefully acknowledging support by Martin Marietta, Truliant Federal Credit Union, Foundation for the Carolinas, Sunoco, Blue Cross Blue Shield of South Carolina, High Point University, and by viewers like you. Thank you.